Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. Good morning, good afternoon, and good evening. No matter where you're joining this episode of The Debt Doctor today, this conversation is for you. We're here today to talk about a type of debt instrument that could have global effects and really an impact on global economies, and that is the bond. But before we get into what bonds are, why they're important, what type of debt bonds are and why they're called bonds or versus just a loan, I would like to thank you for listening. If this is your first time tuning into a Debt Doctor podcast or video, I hope you enjoy what you hear. And if you do, it makes a big difference if you like, subscribe, and share it with friends. We are a new voice to the world of real estate, asset-backed lending, all types of debt. I've spent over 2 decades now buying distressed debt, primarily real estate debt, from banks, lenders, failing sponsors, and the U.S. federal government. I've also worked with thousands of borrowers, both in residential and single-family homes and commercial real estate, and folks that are dealing with upside-down loans or distressed situations on other types of asset-backed collateral. And I have firsthand knowledge of what it's like, both on the borrower and the lender's side, when it comes to dealing with non-performing, sub-performing loans. So let's dig into today's conversation. The reason I want to talk to you about the bond market today is this is a very big topic of conversation among some of this world's most respected financial leaders. I point in particular to one name that is certainly a household name within the world of finance and banking, and that is Jamie Dimon, who runs the CEO and the head of Chase Bank, the largest bank in the world. And Jamie has been repeatedly seen as someone who sees markets before they happen, someone who has a global macro picture on how things should be and are. And he has been sounding alarms over the recent weeks about the bond market, which is why I thought this would be a perfect time to talk about what bonds are. And just to go into Jamie's comments, and the other person who's highly respected specifically within the bond market is a guy named Jeff Gundlach. Gundlach is the head of DoubleLine Company. DoubleLine is one of the largest bond investors and managers in the world. And Gundlach was also quoted this week in an interview on stage in public with Bloomberg, saying that a reckoning is coming for U.S. debt. So that's a broad term, and we'll come back to what that might mean. Let's start with let's talk about what bonds are and why they're significant and why any kind of concern about the bond market could really have global implications. Generally, bonds are considered less risky than any other investment, like, for instance, stocks, or even just corporate loans, or even mortgages in and of themselves on a single basis are considered a riskier investment than bonds. The reason bonds offer more stability is they're usually pooled debt investments. So, and they're only issued by reputable, well established institutions. Often, though, many of the bonds that we saw for years and decades, you would only consider a bond something that came from, say, a bank or the federal government or a local or state municipality, organizations that are so well funded that you know that you're going to receive your fixed interest payment no matter what. Bonds are often used to raise capital for local organizations to build infrastructure, for instance. It is considered a very conservative investment choice because, in general, it's not only a collateralized debt obligation, it's not only a spread amongst multiple types of collateral and diversified, but a it is also issued and by well-established institutions, and it's given ratings by third parties like Moody's, Standard and Poor's, other investment banks do private valuations of these bond programs, and because of that, it's considered to be well vetted. I'm here to tell you it's not always well vetted. Bonds do carry some risk, any investor will tell you. One of the biggest risks that comes with the bond market is interest rates, inflation, and obviously credit risk of the issuer or borrower. Issuer and borrower being the same person. It's interesting how, in the world of getting a loan, you go to ask for a loan, I'm borrowing money from you. But somehow the institutional investment world turns around bonds and says, well, even though we're really borrowing the money from you, we're issuing the bond and we're giving you this opportunity. Inside of that world is where a lot of chicanery can take place. And we've started to see some really less quality types of financial products that are coming out as bonds or securitizations coming to the market, and I think selling, unfortunately, at too much of the same credit profile as something that is much more secure, say, a federal municipal bond. Uh, the reason that bonds are generally less risky is that they're a fixed income instrument. So you would generally do maybe a 3-year bond, a 5-year bond, a 10-year bond. If I go out and raise capital into that bond, it is the bond holders who get paid first. It's always a senior position debt, and they are really the primary first lender to any corporation or collateral that this bond is being issued with. Because they are considered less risky, they are also considered less volatile. They tend to rise and fall less dramatically than, let's say, the stock would. Um, and also, bondholders, in the event that a bond is issued by a company or corporation or group that does ultimately go bankrupt, bondholders usually carry the highest level of priority in the event of a company's bankruptcy. Meaning, a bondholder is probably more likely to get their investment back if a corporation goes bust. Which is why, by the way, if you're investing in low level loans at a big corporation that's already issued many bonds, and if you're a stock market investor, you probably are invested in companies that have issued tons of bonds. Well, that's just heavy debt load. And if those are floating rate debts, one of the big red flags, one of the big canaries in the coal mine, and may be to why Gundlach and Jamie Dimon are pointing to the possibility of cracks in the bond market, is that bonds that were issued 5 years ago were generally, or 8 years ago, are generally really low interest rate items, right? These are low. So, like, if I bought a bond from the federal government 6 years ago, the interest rate was practically zero on that, which is all fine if I agreed to it at the time and I had nowhere else to put my money 7 years ago, like a lot of investors did, or 4 years ago, prior to the rise of interest rates so dramatically starting in 2023. If I was an investor in bonds back then, which many banks, many corporations, many large scale investors, sovereign wealth funds, private endowments, universities, all of these folks invest in bonds. And many of them probably bought very low interest bonds years ago that they've just been sitting in their portfolio, paying a small dividend, which is great. The problem isn't when the bond matures, because when the bond matures, then they'll get all of their money back. Let's say you've invested $10 million in government bonds 7 years ago, even if it was at a 2% interest rate. Well, if it was a 10-year bond, in 3 years, if you hold that bond to maturity, you're going to get your 10 million bucks after you've already been paid all of your insurance. The problem is, what if you need the cash today? And this is where the bond market can get a little hanky. And this is probably where what Jamie Dimon is pointing to when he says the cracks in the bond market are going to happen. He said it at the Reagan National Economic Forum last week. He said, you are going to see a crack in the bond market. Jamie went on to say that the bond market is not only so on edge, but that you are going to panic. This is the head of the largest bank in the U.S. and in the world telling the American public, and more importantly, he's speaking to bond market participants. That's traders, that's investors, that's regulators, that's everyone. And last week he said, you are going to panic, which is not a very common thing for a man that wants stability in a bank, head of the largest bank in the world, to be saying. Why did Jamie say this? Well, because obviously Jamie has been around the block and he has some experience with financial markets. And like many of us who have been through multiple cycles, we see how inflated asset prices are across the board, whether it's in real estate, art, cars, gold, diamonds, silver, everything has a higher price. And you've seen so much investment in products that prior to recently really didn't have weren't considered an asset class of quality to invest in. We've also started to see much more unique and complex financial instruments being sold, and especially just in the last few years. And that's really what Gundlach was pointing to when he was sitting on stage this week with Lisa Abramowitz of Bloomberg. And that's what he was pointing to when he said a reckoning is coming for U.S. debt. And it's and why I think that is because Gundlach sees the complexity of the financial instruments that are being sold to the American public, the complexity of the financial instruments that are being sold to pension funds, endowments, and like myself, he pointed out so artfully last week that the more complex these instruments become, derivatives, bonds with less quality product, more unique structuring, the more it reminds us of the financial chicanery that took place in the early and middle 2000s, which led to the meltdown of the residential mortgage market and the subsequent great financial crisis that it brought us into. And so when you've got the industry's smartest folks in who are in who practice and play in an area of the investment market, the bond market, which is considered supposedly the most stable, least volatile. And when those folks are saying, hey, be careful, the bond market is shaking, a reckoning is here to come, you are going to panic, there will be a crack in the bond market, I think it's time for us to wake up and smell the coffee. Well, I smell the coffee. I guess most people smell roses. I did some Googling, and just to kind of share with you, if you're interested in this topic, um, they refer to bonds as debt securities, IOUs, most often given by established corporations or federal government, state governments, local governments. So you're basically lending money to that issuer. What scares me is not when the federal government or even a state government like California, even if they're high debt levels like we know we all have, we pretty much can be assured that the last thing any government, local, state, or federal here in the US would ever consider doing is defaulting on our debt. That's never happened. And that's probably a reason why these are considered pretty safe investments. But the problem is that government municipal bonds aren't the only kind of bonds that are being sold. And you've got folks out there I just get Google in bonds for sale. There are companies that pop up here claiming to be selling bonds that are really just selling private investment strategies. I'm not going to name them. I don't want them coming after me, but just buyer beware, because the idea of using the word bond implies a level of security and a lack of riskiness, that there are companies out there that should not be using that term. And actually, there are companies out there that have still using the term, still advertising the sale of bonds through their website, and they're facing DOJ charges for misrepresentation in doing it. Now, there are plenty of bonds that are completely safe. Let's go back to those savings bonds, those U.S. Treasury bonds, the municipal bonds. Again, if you're a bank, if you're a holder of this debt, no problem. If you've got a 10-year bond and you're 7 years into it, 8 years into it, in 2 years from now, 3 years from now, you're going to have no problem getting all your money back. And in the meantime, you're probably, if you got something 7 years ago, that was 2018, bond interest rates were pretty low, bond rates were pretty low. It's probably a 2, 3, 4% interest rate bond. The problem is, if you do need liquidity today, and this is where people who invest in bonds that are not highly liquid get into trouble. And when I say people, I'm not just talking about everyday people. I'm not talking about a high net worth individual who, who is not sophisticated. I'm talking about real institutional grade endowments, private pension funds, private investment plans, universities, governments, major corporations, we are seeing a liquidity dry up in this country as a result of the removal of quantitative easing the last few years and the sharp increase in interest rates that we made in 2 years ago to curb rising inflation. We took interest rates in this country basically from zero or just above zero, and where banks in particular had gotten used to almost a decade of being able to borrow money from the federal government for zero and then use that money to lend out at low interest rates. We went from zero to about a 5% average cost of capital at its cheapest point in a 2 to 3 year period starting 2 years ago. And that has had a tremendous implicit impact on financial markets, investor expectations, and asset valuation. If you buy something to a capitalization rate, meaning I'm going to go out and invest in a product, whether it's an investment in a business, an investment in real estate, an investment in an automobile that I'm going to rent out, or like as a rental car company, or if I'm buying yachts or airplanes to rent to Delta, to the major airlines, all of those investments are based upon a return expectation. 2 years ago, as the price of money went from 0 to 5%, folks that might have bought 4% bonds are no longer in the market for 4% bonds because they can buy new bonds today at 5 or 6%. So why would I buy your 7 year in life old bond that's due to mature in 3 years at a 4% yield, unless I really wanted a specifically 3 year bond and was willing to give up a little bit of interest to get there? No, I'd go out and buy a 5 year bond or a 6 month bond or a 10 year bond. And all of those bonds are trading at higher interest rates today, offered by new issuers at a higher interest rate today than the ones that were offered 5 years ago. It's just the facts of the world. It's what the expectations are. But what that leads to is proof that markets have changed and not everybody's taken the hit. Again, if you're the bondholder that can hold on to a 10-year-old bond that's 7 or 8 years old right now, you'll get all your money back. But what we're seeing, and what we're going to see more of, is the opposite. One of the other interesting things that Jeff Gundlach said in that interview with Bloomberg earlier this week is that he talks with financial institutions, endowments, high net worth individuals, private multifamily offices, single family offices, pension funds, universities, major institutional investors he talks to every day. And he pointed out that the liquidity dry up is real. When you're talking to a $60 billion private university endowment that is heavily invested, because when you have money, you obviously want to put that money to work, and they tell you they can't even make liquidity calls or capital calls from some of their investments, where they have zero cash on hand, you know something's getting shaky. And that's probably why Gundlach and Dimon are saying what they're saying about the bond market. Because some of those cohorts are going to have to sell those 7-year-old bonds just to get liquidity. Now, if I go to sell a 4% bond today, something that's yielding 4% in a 6% or 7% bond environment, I am going to have to discount the price of that bond in the sale in order to get my yield to the same level as today's markets. That's the way, by the way, net present value on non-performing loans is determined. That's the way net present value on performing loans is determined. Why would I buy 2% mortgages that were issued, even if they are government insured from 5, 6 years ago? Why would I buy a 2% mortgage today and pay 100% for that mortgage, even if it's perfectly performing, if it's only yielding 2%? If I can go buy a new mortgage, because new mortgages are being issued at 6 or 7%, I would have to be offered a 2% mortgage at such a discount to where it equaled what today's standards are. And this is what I'm talking about in terms of dislocation that exists within financial markets. Anyone who needs liquidity today that has to sell a fixed income instrument like a debt instrument with a fixed income, even if it's a floating rate instrument, if it's non-performing, it's still not worth what the loan says it is because it's not actually cash flowing. And you will see more private equities, more banks, more endowments, more family offices, more institutional investors having to sell these instruments that were based on valuations from 5 years ago, not yet repriced or remarked for today's standards. Folks will have to come to market with that stuff. And that is where you're going to start to see panic in the bond market. If you see it in the bond market where it is supposedly the least risky, the least volatile, the most secure, then that's going to point to the fact that every other loan class out there, even AAA rated securitizations, double Bs, triple Bs, stuff that is backed by assets, all of that gets called into question. And the price of money, the price of borrowing on a global scale will naturally increase. We know that higher borrowing costs are here to stay because, when you go from 0% to 5% standard rates across the board, that's what happens. But what the real cracks come from is when folks are being forced to sell these instruments that were based on valuations from 5, 6 years ago, or even 4 years ago, or even mortgages that were issued 3 years ago, right at the top of the market at high LTVs, and now the market is down 10, 20%. That's where the cracks are coming, and that's where you should get your popcorn ready. By the way, the perfect example, if you want to look at this in real terms, is we saw this happen for a momentary glimpse, which really scared people back in 2020, late 22, early 23, right when the market started to alter, right when the Fed started to raise interest rates and shift the cost of capital starting in late 22. We saw a real effect of this when we saw the failure of two major banks, one on the West Coast, one on the East Coast. Silicon Valley Bank, which was a big tech bank, didn't have a lot of real estate investments, had a lot of bond and short-term plays, had to raise capital one night, and basically became insolvent because they had to sell a bunch of low interest rate securities in order to raise capital. And in order to get money for those, they had to right size the yield on those securities in order to sell them, which means that they had to take a loss on their principal. We saw it again with First Republic Bank, and even more so with Signature Bank, which no one ever saw coming. A very well established bank out of New York with some of the top most wealthy New York families banking there. They got their hand caught in the cookie jar. Had nothing to do with mortgages. Again, it had to do with some bond and some crypto plays that they had made. And so if it could happen to two well-established multi-billion-dollar banks, where in a matter of literally 30 days they went from huge, what considered to be safe, profitable organizations to insolvent. That's the kind of stuff that can happen when you see a crack in the bond market. Well, I hope what you've heard here today. And if you do, don't forget to share with other folks. We're just going to bring you the straight facts. We're going to educate you. We're going to show you case examples. We're going to talk about specifics of how to get out of debt situations. And we're going to speak a lot about the secondary market. Secondary market would be where I would go to buy those bonds, those low yielding bonds at a discount. Now, I don't buy bonds. I buy mortgages. I buy whole loan, first lien mortgages, preferably non-performing, sub-performing stuff where the lack of performance has now created a lack of liquidity and a lack of value to the net present value of that asset. I take that savings I get buying those at a discount from banks or sponsors or governments, and then I can pass that along to borrowers or use that discount as a way to grease the wheels and get that real estate back cheaper, quicker, and turn it over either to a long-term partner or back to the retail market. I hope you enjoyed what we talked about here today. A bond is just a loan. It's just a loan that is wrapped up with a little bit more sophistication, meant to make you feel like it's less risky. But those that are playing in that market are saying risk is abound and it's going to affect everyone. That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on The Debt Doctor.